Good afternoon. We will begin our presentation shortly after at 2 o'clock, so please be patient. Good afternoon, everyone. Thank you for joining us. You are watching a presentation of the state and local tax impact of implications from COVID-19. Happy to have you. I hope all of you are doing well and your loved ones are well as well. And we're grateful that you can attend. This is just our disclaimer that this is not legal advice. This is not tax advice. This presentation is going to walk through our present state of understanding of the state and local tax implications surrounding the COVID-19 crisis that our country is enduring. States are reacting with new guidance by the hour, by the day, and probably this presentation will be out of date by the time this is here completed. So take it for what it is. Consult your tax advisors for more detailed advice, but I think this is a good starting point for us to consider state and local tax implications that you should be aware of. My name is Kevin Soar. I'm a tax specialist with SACS. I'm joined by Matt Giordano, who will be joining us to cover some topics related to federal tax treatment as well as controversy matters. We will begin by reviewing some of the state and local specific tax implications of the current environment that we find ourselves in. So what do I mean by that? This is a time of distress for a lot of, not only for us as taxpayers and for us as citizens, but also for the states. Basically, national economic activity is reduced to a shell of what it once was. Within the past month, more than 22 million workers in the USA have claimed unemployment benefits for the first time. Stay-at-home orders have been in place, which greatly reduces retail activity. Just in March alone, nearly a 9% reduction in retail sales nationwide, and that includes weeks before COVID-19 restrictions really came into play. So that's really about half a month of reduced activity being reflective of a 9% reduction in retail sales for the month of March 2020 versus 2019. All tax bases where state and local governments collect their revenues are being reduced at this time. If you think about it, income taxes at both individual levels and business levels are down. Sales and use taxes are a function of sales volume and retail volumes, which we've already discussed. Those are down. Property transfer taxes are down, employment taxes are down, fuel tax receipts are down for state and local governments as people are driving less. Even traffic fines and parking tickets, all these small ways that the government is accustomed to getting revenue, all of those sources of revenue are drying up for them. And at the same time, states are experiencing increased expenses related to the COVID-19 crisis. So that's a great burden for them. What this means is with reduced revenues and with increased expenses, down the road, we can expect states to get more aggressive and more creative in looking for their revenue sources. Let's look at what this means for a couple of our states. These are projections that the states have issued. I don't put a lot of weight into the projections, aside from mentioning that this is how the states and the cities view their own crisis. New York City is saying that roughly $10 billion shortfall in revenues are going to result from this. New York State is projecting a decline in revenue of nearly $7 billion only through the end of last month. I have not seen them project further, but just $7 billion through the end of March is what they anticipated. New York MTA, the agency responsible for running our subways, our buses, and our commuter rail, as well as our bridges. What are they expecting? They're seeing an $8 billion shortfall. Pennsylvania, up to $4 billion in lost revenues. Again, I don't really trust that these numbers are very meaningful. They're based on assumptions that we don't know, but what we do know is that the states are putting this out there as their idea of what the crisis means to them. And if the state is viewing this as being what you see on the screen right there, then you are going to see them react accordingly. Now, one other thing, a little bit of housekeeping. We are recording this presentation, and we will send slides, and we will send email a copy of the presentation to you shortly after this presentation is completed. So don't feel stressed about writing down any of this information. You'll have it at your fingertips shortly hereafter. So how have the states reacted to this crisis? Their initial reaction, what we've seen so far, is that they're trying to assuage the public, the taxpayers, presenting a rather uniform face of help. They are trying to extend due dates for both paying taxes and filing tax returns. They are suggesting that they're going to reduce or eliminate penalties or interests. And they are suspending collection efforts. While state taxing agencies have been supportive of taxpayers to this point, I just encourage you to keep in mind that this is their way of helping us get through the crisis. But at some point in the near future, those shortfalls that we talked about on the prior screen are going to present themselves, and they will get back to the business of collecting revenues as much as they can, especially to help bridge this gap. So that's how states are reacting. How are taxpayers reacting? And I think we're all seeing this, social distancing, right? I mean, we're not out and about the way we used to be. Businesses are less likely to travel. Discretionary travel is basically gone. We are not meeting clients person to person. To the extent that a taxpayer's geographic footprint is based on his travel activity, his footprint has just shrunk. At the same time, that we're all enduring stay-at-home orders, right? Probably most of us are at our home, our makeshift home offices, going through this presentation as I speak. So we have businesses and taxpayers are more likely to have employees working at remote locations that they don't have control over. We're seeing reductions in headcounts. We're seeing reductions in assets in service. We're seeing delays or postponements of assets being placed into service. Now, all of this happened. What were the trends that were present in the state and local tax environment prior to this, right? There we have sales tax nexus expansion. If you go back to the spring of 2018, the Supreme Court ruled in the Wayfair case that an out-of-state taxpayer selling into a state is going to have nexus in that activity if its sales exceed a certain threshold. So states ever since that, in the past 2 years, states have been uniformly broadening their idea of what their taxpayer base is. We've seen something similar happening on the income tax nexus side, right? And states are always looking to make out-of-state taxpayers their tax base. They don't want to tax their in-state residents. They don't want to tax their in-state taxpayers nearly as much as they would prefer to tax out-of-state taxpayers. So for an income tax nexus, you see what's commonly called factor presence nexus. If you have greater than X dollars of sales into a state, and X is frequently equal to $500,000, if you have more than $500,000 sales into the state, they're saying that you have nexus regardless of your physical presence. I think that as we go forward, let's keep those trends in mind and apply our new changed facts to these to the state's updated laws and interpretations, and keep in mind these trends. So what are some nexus considerations on the income tax side? We're staying at home, right? Prior to COVID-19 policies in place, an employee who is working from home, that was going to create nexus for that employer in that jurisdiction. Is that going to create nexus now? That becomes the question. If you have an employee from an office in New Jersey who sits in New York, is that going to create nexus for that employer in the state of New York? We'll need to wait and see in most states. New Jersey and Pennsylvania have been specific. They identified that fact pattern, and they said the employee who stays home because of the COVID-19 stay-at-home work policies does not create nexus for the out-of-state business with that activity on loan. Now, we'll need to see whether or not other states adopt policies similar to that. Let's talk about Public Law 86-272 for a little bit. Public Law 86-272 says that that's federal law that protects a taxpayer from having an income tax paying obligation if its only activity in the state is limited to soliciting sales of tangible personal property. So what happens if you have a taxpayer who is claiming that protection in a state, and now we have a stay-at-home employee who's doing unprotected activities, activities that typically would not be protected as soliciting sales of TPP. That fact pattern should be considered. As far as I know, no states have issued guidance with regard to Public Law 86-272. Now let's consider some ways that maybe nexus activities might be more limited than they were prior to COVID-19 policies being in place, right? So what do we have? We have reduced travel from prior years. Does reduced travel mean fewer instances of nexus creating activities? Could well mean that. If you have nexus in a jurisdiction based on employees traveling into that jurisdiction, and they now travel patterns are reduced or eliminated, are you still creating nexus? That is something to consider. Now let's consider factor presence. Factor presence nexus is what we discussed briefly earlier. If you have more than $500,000 of sale into the state, they say that creates nexus. Now a taxpayer's sales are down, potentially. Potentially those that threshold for creating factor presence nexus, maybe it was met last period, maybe it's not being met this year. 2020 sales should be considered anew. Our changed facts also give us the opportunity to review some of our sales sourcing approaches, right? So how do we consider revenue that we receive from performing services? There are typically two ways that states go about sourcing serviced revenue. Service revenue can be applied based on where your customer receives the service. We'll call that a market-based solution. It's the trending approach. Or it could be based on where the service is performed. Performance-based sales sourcing solution. Market-based sourcing is certainly more trending. States are moving into that direction, but the question remains, how does our new working environments, or does our new working environment change the way we apply either of these determinations? Let's consider an example. Let's consider an employee who has offices in state A, but has an employee working from his home in state B. How does a revenue that is being driven by that employee, how should that be sourced? In a performance-based analysis, does the employee perform that service from his home location, or does he do it from his office location where he's just temporarily no longer welcome? That's a question that needs to be asked, and I suspect that if you're listening to the call, maybe you have an issue like that. Now let's consider the exact same fact pattern, but not from a performance-based situation, but from a market-based situation. Let's consider a customer is a business that is using a software license, right? That business is headquartered in New Jersey or in state A. An employee is accessing that software from his newfound home location, serving as his office in state B. Now, in a market-based analysis, we look to where the customer is using that software. Is that customer using the software from his headquarter location in state A, where his office is located, or is it now his makeshift temporary location in state B at his home? We need to wait to see if states will issue guidance, but it is a question that should be alive in all of our minds. We also encounter some sales tax issues, perhaps more than some. Sales taxes make up a good portion of how states get their revenue. So where is it that someone is enjoying the benefit of a service? If we go back to the very same example we just talked about, a software license, a company is providing a software license to a business at an office location in state A. That employee is now accessing that software from his home location in state B. For sales tax purposes, is that a state transaction that is finalized in state A, the office, or does it turn into state B where the person actually accesses the software? I don't know the answer to that question, but it's a question that we should be thinking about, and we should be keeping in mind whether or not states will offer guidance to provide clarity on that, because I don't believe that's an issue that's been very interesting, that the states have been interested in asking up until this point. We should also consider whether or not our changed facts have created new services or new offerings that need to be considered for sales tax purposes. What do I mean by that? I mean, sometimes as a result of what's happened in the past month related to COVID-19 emergency plans, we've seen businesses creating brand new products for the first time. We see car manufacturers creating ventilators. We see clothing operations being converted into hospital gown producers or face mask producers. We see private individuals using their home 3D printers to create PPE for hospitals. Now, these are items which have never been used before. Are any of these offerings taxable? And the one thing I'll ask you to keep in mind is some of these items are difficult to assess from a sales and use tax perspective, only because on the healthcare supplies and equipment, sometimes they have non-obvious sales tax treatments. Now, have any of these new offerings created Nexus in these new states? So, for example, if you are looking at this as a chance to create a face mask operation that you can help the country fight COVID-19 policies or the crisis by providing face masks. Does that create Nexus for you in some of these other states? It's something to consider. Other ways that our changed facts can lead to non-obvious tax consequences are on the incentive sides, right? What are two primary ways that we create incentives, or states create incentives for taxpayers, is by looking at assets placed in service and by encouraging the creation of headcount or payroll numbers. We see many states have incentives based on investments in property or investments in people to encourage their in-state economies to blossom. So do these stay-at-home orders affect how we count our headcount? Let's walk through an example, and I think you'll highlight it. Suppose an employer in state A has an employee working from his home state in state B. If the state has previously issued credits based on the employment that is reached within state A, does this employee who is now sitting from his home in state B continue to qualify as a state A employee? And if not, if the taxpayers received incentives based on those headcounts, and those headcounts are no longer met, those milestones are no longer achieved, are there clawback provisions or recapture provisions, which would the state might use to recoup some past headcount incentives now that those benchmarks are no longer met? Let's consider another example. Let's consider a business that put assets into service and achieved an investment tax credit for a machine that's placed in service for a prior year. Now, as a result of COVID-19 policies in place, those assets are mothballed. The employees can't get into the office to use them, and those machines are not running. Are there any clawback provisions for that? In example 3, it's the exact same thing, but now we consider whether or not the machine was disposed. The machine is no longer being used by the taxpayer and it's being disposed of. Does that disposition create a recapture event? All these are things that I think we all need to have in mind as we approach our facts have changed. Yes, some of the laws have changed, but our facts have changed. And are we meeting our commitments that underlied our that form the basis for our incentives in the first place? Now let's consider some of the ideas that individual taxpayers need to have in mind. Generally, an individual is going to pay tax where he works and pay tax based on that in the state where he resides. But in the state of residence, he will create he will claim a credit for taxes paid to the state where he worked. So if I work in New Jersey but reside in New York, I'm going to pay tax to New Jersey, calculate a tax to New York, and claim a credit on my New York return for taxes paid to New Jersey. Now we have, if we just consider an example, same example as before, an employee works in state A but resides in B. Will state A in that case, would the state A treat his days working at home as a day worked out of state? Or because it's his home office and not his real office, will that be an in-state test? That's the question. New Jersey provided that guidance. The other states that we've reviewed have not provided that guidance. New Jersey said that if you're working at home only because of COVID-19 policies, you're not really working at home for this purposes. Your office location is where you are working, and pay tax accordingly. Other states so far haven't been as explicit. It seems like a reasonable approach that New Jersey's taking. Let's wait and see how the issue develops. I think we all need to be concerned about statutes of limitations, or aware of statutes of limitations. So typically, a state reserves the right to review a tax return for 3 or 4 years, based from the date of the return's filing or the due date of the return, whichever is later. And I say 3 or 4 years. It depends on the state. It depends on the type of tax, but it's in that ballpark. So what happens now? Many states are extending tax return deadlines for 2019, and we'll get into that in a little bit more detail. But now that we have an extended filing deadline, when does the statute of limitations run? So let's use an example. We have a taxpayer who filed his 2019 return on time, early, and subsequent to his filing of the return, the deadline was extended from 3/15 to 7/15. When should we consider that 3 or 4 year statute of limitations to start? I think it's likely going to be the extended due date of 7/15. Now this is interesting. I think it's interesting anyhow. Statute of limitations for prior years are in the process of expiring, right? Tax returns that were filed in 2016 or 2017 could naturally see their statutes of limitation periods coming and going during this COVID-19 crisis. So what do? Will those limitations remain on schedule, or will states now use this as an opportunity to extend that statute? New Jersey came out just this week with guidance saying that yes, they're going to extend it. To the extent that your statute of limitations is expiring after April 17, 2020, that statute of limitations is suspended, and it will only pass 90 days following the lifting of the state of emergency. Now, New Jersey's actually been pretty specific and proactive in identifying issues and in addressing their interpretation of them. Other states less so, but I think this is an interesting approach. You should keep this in mind, especially for financial statement purposes. If you have any reserves that are up, that statute of limitations is, you may have a calendar of when your statute of limitations are ending, and those reserves could ordinarily come down. That statute of limitations might not be ending on the same schedule that you had in mind. Now with that, I'm going to pass it over to my co-panelist, Matt Giordano, to address some aspects of the Federal Tax Act. Matt, are you available?
Yes, thank you very much, Kevin. And I would also like to thank everyone who joined us for taking time out of their stressful lives right now to be on this webinar and learn about some of these state issues that we need to look out for in light of everything going on these days. So I'm gonna start off with the discussion on the CARES Act and potential state issues. On March 27th, the President signed the CARES Act. This resulted in some very taxpayer favorable modifications to the Internal Revenue Code. And these changes can affect 2018 and 2019 tax returns, so the states will need to react quickly. You know, if you look at this, you know, we had the Tax Cuts and Jobs Act a few years ago. The states had a significant amount of time to absorb all that and decide which way they wanted to go on those issues. Here, we're seeing most deadlines being extended to July 15th, so it's a very tight window for them to look at all this information and decide what they're going to follow, what they're going to decouple from, and so on. So next item is the economic impact payments to eligible individual taxpayers. Will the states attempt to tax these payments as income? Now, the IRS is treating these payments as advanced tax credits against 2020 tax, so it would be a stretch for states to be able to pull these in as income, but you know, you really never know what a state is going to attempt to do, especially in light of all these revenue shortfalls. The payroll protection plan loan to cover 2.5 months of payroll. Hopefully everyone's very familiar with that and has their applications in and their SBA approval numbers at this point. That is eligible for forgiveness and not includable as cancellation of debt income. So the issue here is, will the states look to tax the forgiven loans? I've also been hearing some other things out there that there might be an issue where whatever expenses the forgivable loan is used to cover would not be deductible. So we'll have to see how states react to that theory out there as well. All right, we're going to move into net operating loss NOL deduction rule changes that also came in with the CARES Act. So under the Tax Cuts and Jobs Act, TCJA, NOL carrybacks were completely eliminated. Under the CARES Act, NOLs from 2018, 2019, and 2020 can now be carried back 5 years. And the IRS has provided extensions for taxpayers to file applications for tentative refunds and are temporarily allowing facsimile submissions. And this is important because those applications for tentative refunds require the IRS to respond within 90-day period. Whereas if you file an amended return, the IRS doesn't have that same type of strict deadline to have to respond and act to the refund claim. So that's very important that they're allowing that extension for those applications. Also under TCJA, the NOLs for non-corporate taxpayers were limited to 250,000, 500,000 single joint, and were subject to an 80% limitation of taxable income for both corporate and non-corporate taxpayers. Now under the CARES Act, these limitations have been relaxed until tax years beginning on or after January 1st, 2021. Now, most states do have their own NOL rules. For example, New Jersey has the alternative business calculation, where they calculate year to year how much losses you're actually able to utilize on a current year return. But there could be some state ramifications from the above changes as well. Big change to the 163J business interest limitation. TCJA imposed a business interest expense limitation on 30% of adjusted taxable income for certain taxpayers. New Jersey, New York, and PA all conform to those limitations. The CARES Act came along and increased that limitation from 30% to 50% of ATI. Now, New York State has already declared that they will not follow the increase to 50%, along with the rest of the CARES Act. But it remains to be seen how New Jersey, Pennsylvania, and some of these other states are going to respond to this increase to 50%. There were also changes to qualified improvement property. So what happened with TCJA inadvertently changed categories of property improvements from 15-year property eligible for bonus depreciation to 39-year property not eligible for bonus. The CARES Act did fix that glitch retroactively, which can allow taxpayers to file amended returns for 2018 and 2019, if they already filed, to claim the additional depreciation. Now, this is interesting because most states decouple from bonus depreciation anyway, so that's not really the issue. But I think the bigger question here is, will states allow the change from 39-year to 15-year, which would accelerate depreciation for state purposes as well? That's going to be interesting because most states tend to follow federal in determining the lives of these assets. But since this was something that's a direct change of the CARES Act, possibly not. So now we're going to move into some updates on department openings and closings and some other controversy matters. And we're going to just kind of hit some of our key states that are important to us and a lot of our clients. But I am going to start off with a federal update as kind of a backbone for what some of the states are doing here as well. So as of right now, all IRS taxpayer assistance centers and service centers are closed until further notice. This includes Ogden, Utah, which is the largest and most productive. Mailings are being returned, so it's very important that if you did send anything certified mail, return receipt, that you hang on to that information because it's a possibility that it could get bounced back to you, and it's important that you have the information for proof of timely filing later on. The tax practitioner hotline is completely shut down, so we are unable to call to request account transcripts. We can't fax in new POAs for the CAF unit to process for us to request transcripts from the transcript delivery system. There is a method on irs.gov for individual taxpayers to request account transcripts if you do need one, and we are available to assist you in that process if you have any issues. As of right now, the only successful correspondence we've had with the IRS are with revenue officers assigned to specific collection matters and revenue agents that are assigned to specific examination cases. Those cases are still ongoing remotely, but all in-person appointments have been suspended until further notice. We haven't seen any new examinations starting up at this point. Most collection activities are temporarily suspended, and this includes installment agreement payments due between April 1st and July 15th. But one thing I do want to give everyone a heads up on, if you have a direct debit already established with the IRS, you will have to contact your bank to get the payment on hold. They aren't going to be automatically stopping those direct debit arrangements. So just keep an eye out for that. So New Jersey, all walk-in services at the Division of Taxation, regional and Trenton offices closed to the public. The call center and email service is operating a reduced staff. Right now, they're operating Monday through Thursday, 9 a.m. to 4 p.m., and they are closed down completely on Fridays. Existing examinations continue remotely. All in-person appointments have been suspended. And we haven't seen any new examinations starting up, but I just want to repeat what Kevin mentioned earlier about New Jersey extending the statute of limitations 90 days past when the state of emergency is lifted. So even if the statute passes during this time frame, there is still a possibility for New Jersey to open up that case down the road. New York State. So New York State, they've kind of been here before. They dealt with 9/11. They had Hurricane Irene. They had Superstorm Sandy. So they kind of business as usual for them to an extent. The call centers remain open. They are requesting taxpayers and professionals to utilize the online services as much as possible, just to alleviate the pressure on some of their representatives at this time. SACS does have an online professional services tool with New York State. So if you currently have any New York State issues going on, we can certainly add you to our account, and there's a range of services that we're able to utilize through that online services account. It's very robust, so please let us know. In-person conferences and field visits are suspended until further notice. Existing exams are still going on. And New York State is allowing a temporary use of electronic signatures on specific documents. New York State's kind of been behind other states in this area. For some reason, they've just been hang-ups on them allowing electronic signatures, but they will temporarily allow them for specific documents. And the type of documents that they're allowing this on are really documents that more so protect their interests. So collection matter efforts, examination matter efforts, things like that. So there are still some documents out there that would require a wet signature. New York City in-person business tax conciliation hearings are suspended. Field visits to taxpayers by auditors are suspended. They do continue to accept calls and online inquiries, and the audit function is continuing remotely. Connecticut walk-in services in Hartford, Waterbury, Norwich, and Bridgeport are suspended until further notice. They are answering emails and phone calls. They're processing returns, payments, and refunds, and other essential agency functions. There wasn't that much detail about what exactly they meant by essential agency functions, and they haven't issued that much additional information to date. Pennsylvania. So Pennsylvania is kind of interesting. The offices and the customer service call center are currently closed, so they're almost in complete shutdown mode. They're encouraging taxpayers to use its online customer service center. The due dates for assessments and notices are temporarily suspended until the offices reopen, and a tax appeals will be considered timely if filed by the later of 30 days after the reopening of the Board of Appeals or the original deadline to appeal. California, the counters are shut down in Los Angeles, San Diego, Santa Ana, Oakland, Sacramento. Most collection activities have been suspended. You can request to skip any existing installment agreement payments. You could do this online or by phone. You do have to request this. This isn't like the IRS. The IRS is kind of allowing people to just not make the payments. California, you would have to make this request. Audits and protest programs continue with modifications, the most obvious one being no in-person conferences at this time. And California announced that they will not be opening any new cases through the end of April. Texas, field offices and audit offices are closed. Auditors continue to work cases remotely. Now, Texas has, in the past, they've had their auditors set up working remotely anyway, so not much of a change for them. The 60-day deadline to contest audit results is temporarily suspended, and on a case-by-case basis, they are also willing to postpone payments required under existing installment agreements. Another thing we wanted to bring to everyone's attention here, we understand these are very difficult times for businesses, individuals all across the country. And unfortunately, there's fraudsters, scammers, and hackers are out there doing everything they can to take advantage of the hecticness and the desperate situations that businesses and individuals currently face. This includes bogus phone calls, emails, or even texts asking for bank account and other sensitive information, promising to make the economic impact payments and loan funds available. Just keep an eye out. Just try to be smart. You see the official term here is economic impact payments. So if you see anything asking about stimulus payments or other types of descriptions, don't fall for the bait, please. The IRS will not be calling anyone to move these payments forward. Everything that you need to do could be done online. You can check status of the payments via irs.gov. You can provide them with additional information if you need to. So just please keep that in mind, and only perform any actions related to the economic impact payments via the irs.gov, nowhere else. There could be potential scam calls for fake state relief programs that don't exist. Better watch out for check washing. There's going to be a slew of checks coming out for people who didn't have direct debit set up with their 2018 or 2019 return. So those checks will be mailed, and they will be attempting to intercept those checks and use chemicals to alter the check payees and the amounts. This is kind of a sad one. Charity scams for fake charities that don't exist, promising to aid victims of the virus. One of the other changes with the CARES Act was they're allowing a $300 above the line AGI adjustment for taxpayers that don't itemize. So most people will be trying to utilize that $300 adjustment. So just be very careful about who you're sending money to. The IRS.gov does have a method of searching for official tax exempt organizations so that you make sure your money's going to the right place and you are in fact eligible for that deduction or adjustment. Most companies have their employees working from home if possible for very long periods of time at this point. And without a proper virtual private network in place, it will be very easy for hackers to obtain sensitive information about your company, sensitive information about your employees. So please keep that in mind. And I know it's tough right now money-wise, but that could be an investment worth making to avoid losing significant amounts of money down the road due to some type of fraud or scam. And for that, I will pass it back to Kevin for due date discussion for income and trust fund tax filings. Thank you.
Thank you, Matt. So I'm going to go through some of the states that Matt began with a focus on due dates for both income tax returns and trust fund returns. But one thing I just want to remind you is that we will be sending out a copy of this presentation by the end of day tomorrow. Don't feel obliged to take notes. You'll get the slide deck with the information on it. And the other thing I'll remind you of is please keep in mind that the tax authorities are updating and changing their guidance on this every day, every hour. It's going to be outdated pretty soon. We provide this to you for discussion purposes, and we provide it to you so keep in mind how different states are approaching our present crisis, not so much to give you a blueprint for filing compliance. So first, let's consider what the federal tax implications are. Income tax payments and filings which were due on or after April 1st and before July 15th have been extended to July 15th. So all of those individual income tax returns which were due on April 15th have been extended to July 15th. Automatically, there's no filing that needs to be done in order to achieve that extension. Most states have followed the federal guidelines here, but there are some key differences in the state due dates, and also the states have a lot of different mechanisms for assessing tax, right? We have income taxes, but we also have payroll taxes, we have sales taxes, we have other taxes that the federal, even if the states wanted to follow the federal lead, the federal IRS is not actually performing any leading function as it comes to sales tax. So there are some gaps in how the states are approaching this. This is a chart. I'm not going to read off every jurisdiction for you. You might find it useful, and again, you'll have a copy of this by end of day tomorrow. We will highlight a couple of the items which you'll find in these charts though. So, and we'll highlight some of the states that we think might be of most interest to you. They're in the presentation. I will discuss the aspects that I think are of most importance or of most interest to you, but please feel free to look at all of it when you have it. New Jersey, on the individual tax returns side of things, payments and returns have been extended until July 15th. You don't need to do anything about it. The extension is automatic. Estimated payments for the first quarter have been extended until July 15th. Second quarter estimated payments on the 1040 ES, second quarter payments have not been extended. Those continue to be due in the middle of June. On the corporate side of things, again, the extension is automatic to July 15th. This applies to calendar year tax filers with an original due date of April 15th. Corporations are automatically extended to July 15th. For partnership returns and payments, those are extended until July 15th for calendar year filers with an original due date of April 15th. You'll see that the state, New Jersey, other states as well, they target their relief on the assumption that many taxpayers are calendar year taxpayers. So keep that in mind. If you are not a calendar year taxpayer, the guidance might be off point. Not specifically listed in New Jersey's extension, but it is our understanding that first quarter estimates for non-resident partners withholding has also been extended to July 15th. Second quarter payment continues to be due June 15th. You should also be aware that New Jersey in 2020 for the first time has an optional business entity tax for pass-through entities, perhaps similar to Connecticut's, except that with the big exception being that it's optional rather than required. No estimates are required for this year. New Jersey had not issued any estimated payment forms for that new tax, and they are not going to. So just keep that in mind. There's a new tax regime there. It may interest you. No estimated payments are needed. New Jersey articulated it this way, and we provide you with a full quote of what the Division of Taxes provided, because I think a lot of states feel this way. And I'll just read it for you. Taxes collected by a business and held in trust for the state. When collected, trust fund taxes are not the property of a business and should not be used for the business's own use. A business simply remits these funds collected from a consumer or withheld for an employee to New Jersey. Since the business would have already collected or withheld these amounts, there will be no extension granted with respect to payments. So New Jersey was very explicit with this. I think a lot of states feel this way. You'll notice that sales tax relief isn't nearly what it is on the income tax side. New Jersey is explicit, and I think they're representative of what other states are thinking. Let's talk about New York. Income tax returns and payments have been extended until July 15th. Trust funds, sales taxes, if you missed a payment on March 20th, there's potential relief there, and that relief reflects an awareness of the department that COVID crisis initiated right in the middle of March. The logistics of actually filing those returns were still being worked out. At this point in the crisis, the expectation is that taxpayers now have access to their records and can get around to both paying and filing these returns. The guidance providing relief from March 20th was sensitive to that initial onset of the COVID-19 crisis guidelines. These other extensions, I'll go through them. You'll have this in the deck. I think they're good for you to know. Pennsylvania provided a chart. That chart is Pennsylvania's own. We provided it for you. Interestingly, in Pennsylvania, first and second quarter estimated payments have been extended to July 15th. And corporations have been extended through August 14th. Note that odd date. That is not a typo. Corporations have been extended through August 14th. Trust fund taxes, if you are part of an accelerated sales tax prepayment program, that has been suspended through June. Businesses can remit the taxes that they've collected, but the actual accelerated sales tax prepayment program was suspended. Businesses that normally have monthly prepayment requirement will not be charged penalty payments for missing those prepayments. California, I'm just going to go upon that. Note with California that that first bullet there, small business taxpayers with less than 5 million in taxable annual sales can take advantage of a 12-month interest payment plan for up to $50,000 of sales and use tax liability upon request. Note those last few words, upon request. If that is something that you qualify for and interests you, consider requesting it. They will not extend it to you automatically. Texas originally has a due date of May 15th for the franchise tax report. That's been extended through the middle of July. And again, Texas, like California, is offering short-term payment agreements. And in most cases, they will waive penalties and they'll waive interest, but that needs to be requested. That is not an automatic extension. That is something that needs to be requested. And now we are at the part of the program where we will field questions. I know that questions have been coming into the system over the course of our presentation. We will get to some, and please, if you have any questions, we'll provide you with an email address following this presentation that you can send all your inquiries to. So Matt, have you had a chance to look through any of the questions that have come through? Anything that looks like they could be of broad interest or broad appeal?
Yeah, for sure. This is definitely a good one. Do you think states will kick up amnesty programs to try and recover lost revenues as a result of COVID-19?
Amnesty programs. The states typically will open up an amnesty program when they're in fiscal straits, and I think that's a good question because I think they could be going there. Every state that has talked about the issue has talked about how they are going to experience financial stress. And an amnesty program is a good way for them to get new taxpayers on their books. So yes, I would expect that. Taxpayers should also keep in mind that before the amnesties are announced, if they want to clean up any past liabilities, they can do that through voluntary disclosure programs. Those are, taxpayers just go straight to the state and ask for a waiver of penalties and a limitation on look-back periods. It's something to consider, and that's always available even if the amnesty program is not.
Okay, let's see what else we have. Okay, do you think any of the changes will be long lasting, or will they only last through the crisis?
Will the changes be long lasting or temporary? So the way that the changes have been announced so far is that they're temporary, right? So sometimes they're announced and they are, we saw in New Jersey with the statute of limitations, it will extend 90 days beyond the state lifting the state of emergency. Who knows when that might be? But that's at least a specific date. Once that state of emergency is lifted, the clock will start 90 days later. That plan will end. Other ones are written a little bit more vaguely, where they just say that the policy will be in place through the COVID-19 emergency, without really specifying how that end date is determined. One thing I would keep in mind, though, is that maybe facts might have changed permanently. You know, maybe the state's interpretation or application of their rules and laws might have changed temporarily. But if your facts have changed permanently, then that's going to be a different result. I'll give an example. What happens if someone's working from home right now because they're required to? Historically, they had only worked from home in times of an emergency, in times of maybe a blizzard or bad weather, or a car broke down, or a child was sick, they worked from home. Now they're working from home every day, and maybe they're getting pretty comfortable, and they're going to continue to do that following COVID-19. If that's the case, then the temporary safe harbor that New Jersey and Pennsylvania give a taxpayer for Nexus creation activities, that's going to pass. But our facts may have changed in a way that would permanently change the way that Nexus determination is made. I mentioned the Nexus example because it's the one that comes to mind, but I'm mindful that it probably applies to a number of the topics we've addressed.
Thanks, Kevin. All right, let's see what else we got. Do past emergencies help us understand how states will go forward with this emergency?
So about past emergencies, what do you think in mind there? Maybe like hurricanes or something like that? I mean, past emergencies where states have provided like timing relief that come to mind are terror attacks, obviously, and hurricanes or weathers or blizzard, things like that. I'm not sure if those are very helpful in informing what we can expect going forward. Most of those events were localized and perhaps short-lived. Like we could expect when the hurricane is not going to be a problem for 3 months. It'll be a problem for 3 weeks. This one, I don't know that anyone's really providing us this kind of guidance that we need to get comfort that this will be over, in 3 weeks or 3 months or 12 months. So I don't know if we can get a lot of perspective by looking at the past right now.
Okay, thank you. I think we have time for probably one more question. Okay, what are the most common client issues that we've been asked, state-related, throughout this crisis?
That's interesting. Well, we are getting client questions related specifically to this, so we are informed by that. I had one client saying that they're moving a lot of their sales function away from retail outlets and online. So that right there, we're dealing with Wayfair Nexus style analysis. Maybe they had those issues before, but they come to the forefront now that people are selling more remotely than they are in person. Had another client begin making face masks, and that raises questions about whether or not face masks are subject to sales tax. Same thing with hospital gowns. That question didn't come up, but it's the same sort of thing. And medical supplies and medical equipment is one of those areas of tax where the outcome, does sales tax apply to this? It's not always obvious, and it doesn't always make sense. The rules are there, the states are different, and they need to be addressed state by state, item by item, without an idea that that there's some sort of logic that is going to undermine all of it. And then this one probably comes up the most, and maybe we can all relate to this a little bit, is logistics have become difficult. I mean, printing and mailing and getting signatures on a piece of paper. If we needed 5 signatures on a piece of paper, that would have been relatively straightforward a month ago, 2 months ago. Right now, that's a challenge. Auditors are familiar with this challenge. They have this challenge themselves. They're not going into the office either. So, no, you're not alone. The taxpayer, our friends at the states and the cities are helping us with it, but that's probably the biggest thing. I think that probably brings us to our conclusion. Matt, thanks for joining us. And I'd like to thank everyone who participated in this. I'll remind you that the deck will be coming to you by the end of business tomorrow. Please email your questions to covid19@sacsllp.com. Again, that's covid19@sacsllp.com. And we will be manning that email account to make sure that we get back to you as soon as possible. Thank you for being on the call. We really appreciate it. Stay healthy and stay safe out there, and look forward to meeting many of you again in the near future. Take care.
Thanks, Kevin.